So I'm gonna keep my comments very short, because we want to get to the presentation and David is here, David Blackburn for Action Benefits. I don't know if any of you have worked with Cynthia Brown in the past on pre-retiree healthcare. Cynthia retired and she had been working with Action Benefits for many years, kind of in the background. So she had overflow of clients, needed special help with complicated cases or needed to interface with insurance companies. Action was kind of her go-to behind the scenes. So when she retired, it was kind of a no-brainer to kind of hand the clients off and say, you should work with Action. And so we have been kind of talking to them for months now, have kind of gone to their place of business to see how they do their work with clients and have been very impressed. So I have no problems. We have no problems about you working with them. We think they do wonderful work. She would have actually been here, Cynthia, but she's not been feeling well for a while, so couldn't be here tonight. But we don't do insurance. We are not experts in insurance. We usually know enough to be dangerous when it comes to the insurance. When it comes to Medicare, we do know the basic facts. We know the planning side of Medicare. Where premiums start to get more expensive, how it basically works. On the pre-retiree healthcare side, we know about needs for insurance, and we know that even more complicated is how sensitive your income is to premium. So you think you can have to be careful about how much you earn in order to start paying more on the Medicare side. David will talk to you about how quickly your premiums might go up or be more expensive when you get to pre-retiree healthcare. So when we are working with pre-retirees and their healthcare, if we have the option to decide where to take income sources before you get to age 65, and we can massage, sources of income, we will do that when we're working with Action or whoever your consultant is, so that we can keep your income low in order to potentially get subsidies. And I guess there's maybe some things changing there, but in order for you to pay less in premiums until you get to age 65. So those are the things we can do when we're collaborating with your insurance consultant in order to, keep costs as low as possible for you. And that's always, one of the ways that we're consulting with your other professionals as we are working on your planning. So with that, I'm going to hand things over to David. I know things are changing and there's a lot of information, so we'll give you as much time as possible here.
Thank you, Sandy. So I'm David Blackburn. I go by Dave most of the time, but you can call me anything other than late for dinner or a tiger king, which is still delayed, by the way. I work for Action Benefits. I've been with them about 15 years now. We are an agency, family owned, third generation, just down the street in Southfield. We were founded in Detroit in 1957. And as Sandy mentioned, we work not only with our own internal agents, but we're also a full service insurance services company. So we work with agents like Cynthia Brown and others all over the country, helping them with knowledge, technology, product, and all sorts of solutions to help them suit their clients. So we cover a pretty wide range. And I am relatively, I wouldn't say expert because there's a lot to know, but I'm comfortable in most markets: Medicare, under 65 individual, and group employee benefits. So I have a nice, well-rounded experience to talk to this topic tonight. As you're approaching retirement, before that transition to Medicare is a challenging time from an insurance perspective. Most insurance products are rated based on age as a significant contributing factor. And so you're at the upper end of the premium spectrum until you get to Medicare. So there are a lot of different strategies and a lot of options. the truth is, there isn't one single solution, and healthcare is an incredibly personal decision. So I'm going to throw lots of information your way tonight and give you some insight. As Sandy said, there is, well, health insurance is always kind of dynamic. You know, year over year, we face lots of changes from regulatory bodies and so on and so forth. This year is a little more challenging than most, and we'll talk a little bit about that. But I'll just disclaim it in saying there are things in here that may change. I'll try and point them out. But really, if you take one thing away from me tonight, I would say the best thing to know about insurance is that there are good, educated insurance professionals out there, agents and brokers, that can help you evaluate your specific situation and find the right solutions for you. So whether you choose to work with Action Benefits or your neighbor down the street who's been doing it for 40 years or anybody, I always say, work with an agent. Don't go directly to the carrier, directly to the marketplace. You need an advocate that's truly independent and on your side, and that's what they're there for. So with that, we'll dive a little bit into options in the pre-65 space. Most of our talk tonight is going to cover, oops, I guess I'm getting ahead of myself there. But you do have options in the individual market, whether it's marketplace, subsidized coverage, ACA coverage that is purchased off marketplace direct from the carrier, private underwritten plans, short-term plans, health sharing arrangements, even Medicaid in some cases, although I doubt that's a topic many of you are facing since you're working with a financial planner. You may also have some employer-based options, whether or not you've thought to consider them either through a spouse, entire employer-sponsored retiree plans. We see less and less of these, but they do still exist. COBRA is an option for lots of folks, and then even though COBRA gets kind of a bad rap, it can be the right option in some circumstances. And last but not least, I include this only partially joking because I do have clients that bring it up. Going back to work part-time, there are some companies that do provide some decent benefits without making you work a full work week. But obviously, the most likely option for folks, if you're not working pre-65, falls into the individual market, but likely the more balanced options live kind of in the employer space from a benefit cost perspective. Weighing out your individual options, coverage on the health insurance marketplace. I was thinking earlier that this slide maybe should have been titled ACA compliant plans, because as I mentioned, you can buy ACA or Affordable Care Act compliant plans either through the federal marketplace, healthcare.gov, which an agent can assist you with, or you can go it alone with the website. Or in many cases, you can buy them directly from the carrier through an agent, or even just calling it a carrier's call center. The difference is really about tax subsidization. So we'll cover that in good detail. But for ACA plans, regardless of whether you buy on or off marketplace is kind of the language we use, they generally break down into what's known as a metal tier or a metal level. And so you've got platinum, gold, silver, bronze, finally catastrophic. And I'd encourage you to think of these as having nothing to do with the quality of care or coverage that you're getting. They really relate specifically to the portion of cost of care that the plan covers. So we'll talk in detail here in a second. The other things to know about ACA coverage, some of the really good points about ACA coverage specifically is that they cannot have any kind of a prohibition for pre-existing conditions or a waiting period for them. They're guaranteed issue. They cannot be medically underwritten, so there's never health questions. And they're all required to cover 10 essential health benefits or EHBs. Pretty basic stuff, the things you want in a health plan, generally speaking. A lot of these are covered without cost sharing. Anything preventive in an ACA plan is covered really at no direct cost to you out of pocket. So even though it's reflected in your rates, you'll go to the doctor for a vaccination and you won't be billed, so on and so forth. Getting into the tiers, as I was saying, think about the metal level relating to the portion of a medical expense that the plan pays. You'll see off to the left side there, 90%. Platinum plans cover roughly 90% of covered expenses when billed to the plan. So, we call those percentages actuarial values. They're set by the law, and plans to meet these tiers have to meet the requirements covering that amount. They go through annual testing when they file rates. Platinum plans are great. They cover a lot of your services, but the downside to them is that obviously the premiums are higher, so you're gonna pay more month over month. You'll pay less out of pocket as you use your coverage. So, depending on how you like to pay for things, you're gonna shoulder things a little bit differently there. They tend to have the lowest deductibles in the market and the lowest out-of-pocket maximums. And they're a good choice if you can afford the premium on them and you have high utilization. If you expect to see the doctor a lot, or if you're treating chronic conditions, they can be a good option for you. A lot of what you'll hear tonight is that finding the right solution is about evaluating your needs and your risk tolerance too. Because, something like this is going to give you a lot of peace of mind, but it's gonna, take more out of your savings or your checking every month. Moving down to the gold tier, you'll see these plans cover roughly 80% of covered and billed services. Again, they're at the higher end of the premium spectrum, but the deductibles and co-insurance and all of those things are gonna be a little bit lower as you use the care, and they're a little bit more balanced option. In the silver tier, this is where you start to see a bigger difference, and we're gonna end up talking a lot about silver plans tonight. All of the ACA is benchmarked around the cost of silver plans, so they cover roughly 70% of expenses, and they're right in the middle, as you'd expect for a silver. The premiums are fairly moderate in relation to everything around them. They have relatively low costs when accessing your care. Their deductibles are lower than a bronze plan, probably a bit higher than a gold, obviously. And they do have a little bit more out-of-pocket maximum exposure. So each plan has a cap in what you can spend in a year. That's your out-of-pocket maximum. It's gonna factor in your medical expenses and prescription drugs for anything that's covered by the plan. These are gonna be slightly higher than a gold, but if you expect lower utilization, you're less likely to hit that maximum. So they can be a very good option. Silver plans also, if you're able to qualify for tax credits and cost sharing reductions, are the only plans you can get cost sharing reductions on. We'll talk about that in just a minute, though. Again, bronze being the lowest metal level, they cover about 60%. This is where you're going to find the lowest premiums in an ACA qualified plan, as well as probably the highest cost when getting care. But they're still going to cover all of the same things. You're still going to have those 10 essential health benefits covered, your preventive care and those services. And these can be a really good option if you're healthy, Quite honestly, if you're not looking at chronic conditions, you don't expect to see the doctor more than for, your usual physicals and the occasional upset stomach or something along those lines. A bronze plan can be a great option, despite the fact that it's a bronze and sounds a lot less sexy than gold or platinum, right? So now I have skipped here through catastrophic. We'll talk about that a little further in, because they're ACA qualified, but they're very different. When we talk about buying on market versus off market, or on market versus carrier direct, what we're really talking about is qualifying for premium tax credits and subsidies. How do we lower the cost of your care? Excuse me. And so bear with me a second here. Okay. This is where you'll see some of that volatility right now. I don't know if any of you have been following the news of the government shutdown, but a big part of that is related to, individual health insurance subsidies. Under the Inflation Reduction Act, and President Biden, they expanded subsidy qualification because of COVID. They wanted to make sure more Americans had coverage and could afford it. And so the typical formula used to calculate subsidies changed, and it made subsidies available to a much wider range of people and gave them much more in subsidy. So the last I looked, Kaiser Family Foundation, which does a lot of analytics in healthcare, said that 92% of current individual marketplace purchasers are eligible for marketplace subsidies because of that expansion. Now, the Democrats are holding out, hoping that those subsidies or this expansion set to expire at the end of this year can be renewed. Because going back to the old qualifications, we'll talk a little bit about how that works soon. Going back to how the old qualification worked, it creates what people are calling a subsidy cliff. There will be people who no longer qualify for any subsidy, and the vast majority of people will qualify for much less subsidy. And given external forces within the health insurance market and the cost of care going up with inflation, because hospitals and doctors feel inflation just like the rest of us, we're also expecting some of the highest rate increases this year that we've seen recently. And so if you've heard news stories talking about people facing a 75% increase in cost or even cost doubling, I'd love to tell you that's a scare tactic. In reality, there is a significant possibility for some folks, if you're a high income earner that was receiving subsidy on the marketplace because of the expansion, and that expansion goes away, premium rates on your plan go up, say 20%, 75% increase is not really out of the realm of possibilities. So, so much more to come regarding subsidies staying expanded. But what you need to know as far as subsidies go is that they are based on MAGI, modified adjusted gross income. They exist on a sliding scale, and it's based on your household MAGI. So not you as an individual, you as a tax household. This does mean if you have children that are part of your tax household and they have income, it can impact your subsidy qualification. This is why we list out the number of people in the household. And then the federal poverty level is really kind of the benchmark that drives the sliding scale. In Michigan, which expanded Medicaid under the Affordable Care Act all the way back in 2014, the qualification for subsidies is between 138% of the federal poverty level and 400%. If you are below 138%, you qualify for Medicaid, so they don't offer you subsidies. Theoretically, if you're above 400%, they don't think you should need subsidies, so you wouldn't qualify. But this will give you a sense of the dollar figures in annual terms regarding your household size and what the top end of subsidy really looks like. That modified adjusted gross, the MAGI, not just a story by O. Henry about Christmas gifts. It is really your adjusted gross income from your taxes with a few things added back in, potentially. If you have them, it adds back in, I guess here somewhere. Untaxed foreign income, non-taxable social security benefits, and tax exempt interest. So doesn't impact everybody, but it may impact some, and it's worth knowing. The other thing that can be tricky about subsidy calculation is that you're really using past performance to predict the future, in that you don't know what your income is going to be in the coming year. Realistically, we all can make assumptions based on our experience, but that can change. So you are basing your subsidy on what you expect to earn in the coming year, not what you earned in the previous year. So it's really important to be mindful of that. And if you have changes in income, to report them because it can make a big difference on your taxes. The way tax credits work, or the premium tax credits work, as I said, you go out to the marketplace, or your agent goes out to the marketplace, They qualify your income based on that magi. And the government decides you qualify for some percentage of federal subsidy to apply towards any plan that you choose on the marketplace. Metal level doesn't matter. You can elect anything you like, and you can then apply the full subsidy to the plan, a partial subsidy every month, or you can hang on to all of it. It all comes out in the wash when you file your taxes. So essentially, if you claim too much subsidy, they're gonna pull some money back from you either out of your otherwise tax refund or you're gonna get a tax bill. If you claim too little, you're gonna get that back in additional refund or a lower tax bill. So, your standard income tax is the mechanism that manages all of that. I missed your. Cost sharing reductions, those CSRs I mentioned. These are interesting because they're another mechanism to reduce the cost of your care. They're available also on a sliding scale based on income. And they work a little bit differently. Rather than addressing the premium cost of the plan, they address the actual plan dynamics, your deductibles, your coinsurance, your copays, those kind of things. And so to qualify for cost sharing reductions, or I should say, if you qualify for cost sharing reductions, you have to purchase a silver plan because they're only available with silver. But they will significantly impact how much you pay out of pocket. And of course, members of federally recognized tribes or Alaska Native Claims Settlement Act corporation shareholders may also qualify for CSRs regardless of income. Little known fact, but it is true, and I have run into it twice in the last year. So when we talk about cost sharing reductions, the things to notice, the first is in this column here. These are just standard Blue Cross plans, right? The Silver 70 is really your traditional Blue Cross Silver plan that covers about 70% of qualified expenses. When you start to qualify for cost sharing reductions, which is for anybody under 250% of the federal poverty level, what you'll notice is that first they add a different number to the name, and that corresponds to the actuarial value. So in that 200 to 250 range, you're going to see the plan covers 73% of qualified expenses. Down a little further, 87, and then finally 94 if you're in that 138 to 150% of the poverty level. And then, as you look at this, and if you think of that first line there as kind of the benchmark, your standard silver plan, you'll see that the plan really changes in terms of the components you interact with. The deductible starts to decline as the actuarial value gets higher. And in that 94, your deductible's down to 250, 10% of where it started. The same is true for your out-of-pocket maximums. Your overall exposure here gets much smaller with the cost sharing reductions. But features like your primary care physician copay may not change depending on the plan. Same with urgent care. Each carrier can handle this a little bit differently. They find the savings and create additional actuarial value in different ways. But ultimately, what you're going to experience here, you're qualifying in these income ranges for a fair bit of premium tax credit to reduce your monthly cost and your monthly bill. And then you're also getting much lower bills from your doctor or what you're expected to pay the doctor. The plan's still paying them the same amount regardless. I apologize, my voice is a little scratchy. So again, eligibility thresholds for cost sharing reductions here. Again, you're gonna look to the number of people in your household and that household modified adjusted gross income. Here are kind of the gates in different federal poverty levels. So lots to remember here. These change every year and they have not released the numbers for 2026 yet. They will adjust up, generally speaking. But this is what they were last year. They probably won't be significantly different. key things to remember, obviously, regardless of cost sharing and premium tax credits, changes to your income will impact it. So if you lose a job, take a new job, any kind of a significant change in your income throughout the year is worth reporting to the marketplace at the time and to allow you to adjust your subsidies so you don't end up with a significant tax hit at the end of the year.
Quick question on that. Do they look at, for going into next year, for instance, do they look at 2024 MAGA to determine 2026 rates? So if your 25 income is very different?
You're really predicting your income in 2026 for 2026 coverage.
Right.
Is the trick. So they're not looking necessarily at 24 or 25. You are giving them a prediction of what you expect in 26.
So it's different than Medicare.
Yeah.
Most likely, like, you're getting healthcare because you retired, so to look at last year's would
Right.
not make sense. But yeah, it's way different than Medicare. 'Cause Medicare looks like 2 years
Yeah.
prior. And why?
Yes.
Who knows?
Yeah, and that predictive nature is part of what makes this really challenging. That's why I'm so adamant that, like, if you're not making what you expected, better or worse, report it and collect the correct amount of subsidy, because it's better to do it on the front end than to be surprised in April when you file your taxes. And I have seen folks that made bad assumptions about their income really get surprised, So definitely something to keep in mind, that it is constantly evolving throughout the year and you want to stay on top of it. Actually enrolling in individual and family coverage. There is an open enrollment period. It runs, generally speaking, November 1st through January 15th. I have started to hear some questioning about whether that'll happen this year, because of the unknown about subsidy, and literally insurance carriers are required to file rates for plans for every quarter of the year with the Department of Insurance and Financial Services here in Michigan. This year, all of our local carriers and all of the nationals filed proposed rates for both with the subsidies continuing at the expanded level of the Inflation Reduction Act and without. And the Department of Insurance and Financial Services has not approved either of them because no one knows which will be accurate. So at some point, barring intervention from the federal government, that November 1st date is going to start to look pretty dicey. And we're not really sure how that's going to be addressed. But in any normal year, November 1st through January 15th is the only time that you can initiate a new individual coverage without a qualifying life event. I'll tell you a little bit about those in a minute. Or make a change to your plan without a qualifying life event. So the reason they do this is really, it really protects insurers. It prevents people from going without coverage and buying a plan when they get a cancer diagnosis or, something along those lines. So the open enrollment period is kind of critical to keeping the financials of the system afloat. But anyhow, it does give you a good opportunity year over year to look at your needs, look at your income, reevaluate and make changes. And carriers release new products year over year. So, as they find the medical environment shifting and cost shifting, they're constantly redeveloping plans to better address things, better cover the newest drugs and, all of the things that people want from their health plan. So, special enrollment periods happen when you experience a qualifying life event. Generally speaking, you get 60 days before that event, 60 days after the event to enroll, and they will usually retro the coverage to the date of the qualifying life event, depending on the event. I know that sounds very wishy-washy. It varies a lot because there are a lot of different types of events that qualify.
Question on that,
Mhm.
real quick. Coming off Cobra, is that a qualifying life event?
It is, as long as as your COBRA terms.
Yes, like you go to full.
Yeah, if you've
18.
exhausted COBRA, it's a qualifying life event for sure.
Okay.
So the major categories of qualifying life events Changes in household size, so marriages, birth of a child, death of someone in the family, someone aging out of dependency, those kind of things will qualify you. A loss of coverage in the past 60 days, if your employer terminates coverage, or if you lose your job, if you exhaust COBRA. Changes in residence in the past 60 days. This one can be a little bit nuanced. Generally speaking, if you move outside your zip code, you're probably eligible for a QLE. The exception being, insurers use rating areas basically. So if you don't cross a rating area or you move into a spot where the plan you're in is rated the same and also offered there, because plans can be different from one area to another, it wouldn't qualify you. But if you cross a rated line or you move into a territory where your plan's no longer available, you absolutely can make a change. And then there are a laundry list of other things that can qualify you that we don't see very often, quite frankly. Things like becoming recognized as a member of a native tribe, which is apparently quite a process and a lot of paperwork to do. Trying to think, there are quite a few others, but the big ones really fall into those first three buckets. I'd be remiss speaking to this crowd if I didn't talk a little bit about HSAs, because they are a fantastic tax advantage way to cover healthcare costs and do some investing while you're at it. You can use them to pay for qualified medical expenses. You can save money and reinvest it. You can even use them to pay for premiums in a lot of cases. The rule of thumb here in the ACA market is that they have to be paired with a high deductible health plan or a qualified health plan. New this year, one thing the government has announced is that all individual bronze and catastrophic plans will meet the requirements. So you can have an HSA with any of those lower actuarial value plans, which is kind of a nice expansion. Before, there were actually some bronze plans that didn't qualify, which everybody thought was a little wonky. But with an HSA, your contributions are pre-tax, so it reduces your taxable income, saves you some nice money. The money in the account is not taxed, even if it's earning interest or investment returns. Money taken out is not taxed as long as it's used for a qualified health expense. So again, you must have a qualified health plan. They usually have an identifier in the name, whether it's Silver Saver or like Blue Cross and Blue Care Network are notorious for actually calling their plans, Gold HSA option 2 or something along those lines. And you cannot be enrolled in a non-HSA plan through a spouse. So if your spouse has a non-qualified plan, you can't have an HSA on top of it. You can't be claimed as a dependent on somebody else's tax return. And you cannot be enrolled in Medicare. HSAs and Medicare do not play nicely together. In fact, just mentioning Medicare, if you are in an HSA qualified health plan, and you're making the transition to Medicare in the near horizon, you have to stop contributing to the HSA 6 months before the month you apply for Part A. So you have to think kind of long-term in that sense, because there are tax penalties otherwise. And in most cases, these days, folks don't get Part A automatically like they once did. The exception being if you start collecting Social Security at 62 and a half, in that case, you would be kind of lined up to automatically enroll in Part A. In that case, you absolutely need to stop contributing to your HSA by 64 and a half. So something to keep in mind. Again, I don't expect anybody to remember all these details because I work with professional agents and we're constantly looking this stuff up ourselves. So just keep it in mind and call your advisor when you've got questions and don't put it off, because the penalties can be stiff. And if you weren't here for last week's Medicare talk, we talked a lot about late enrollment penalties and so on and so forth. Some of those are lifetime penalties that once they're assessed, you're going to be paying more forever. So always good to stay in front of that stuff. But qualified health expenses can run a huge gamut. You can use them to pay for your deductible or your copays or your coinsurance. You can use them for certain over-the-counter medications and first aid supplies. In some cases, there are even household items that are technically HSA qualified. But another interesting facet is that you can use them to pay a good number of insurance premiums. So if you're on Cobra, you can use an HSA to pay your Cobra premiums. Health insurance premiums if you're on unemployment. Medicare can be a little sticky here, but you can use them to pay, like after you've stopped contributing, you can use HSA funds to pay for what we call part premiums for A, B, C, and D. So that would be your part A, hospital, part B, your doctors. C is Medicare Advantage if you elect Medicare Advantage, and D is drugs. The exception to the rule is that you cannot use HSA funds to pay for the premiums on a Medicare supplement plan. And that's really kind of a shame. It's something that a lot of our industry associations have worked and lobbied to fix for a number of years now, not successfully to this point. There are some limits to be aware of with HSAs, specifically around contributions. These do raise every year, or they index theoretically every year. I can't think of a year they didn't go up, but here you can see the change from 25 to 26. Those numbers have already been released. If you're 55 and older, you're also allowed to contribute an additional $1,000 is what they call a catch-up contribution. And then minimum deductibles really speaks to that HSA qualified health plan, having a high enough deductible that the government says you can pair it with an HSA. Maximum out-of-pocket expense limit. This one doesn't come up all that often, but it's really how much of those funds you can use to pay for the plan itself and not another qualified expense. So HSAs are a great way to save in general because of the tax advantage in them. And I highly encourage it. Something I've had through our employer plan for a lot of years. And it never ceases to amaze me year over year how quickly the money stacks up in it and how nice it is to have when my kid breaks a leg or something. And I end up hitting that out of pocket maximum because I've got 3 little kids and I'm usually out of my deductible about March and usually at my out of pocket by June. So I love those HSA funds. Really great. Now, I told you we would talk a little bit about potential alternatives to ACA compliant plans. There are quite a few, and they're becoming more of a talking point these days, specifically because of premiums. Medical inflation, especially because of specialty drugs. You hear people talking about GLP-1s for weight loss and stuff. The impact they're having on insurers is beyond profound. Last year in the Medicare market, Blue Cross Blue Shield of Michigan took almost $1 billion loss. They attribute a huge percentage of that, north of 50%, to specialty drugs, and GLP-1s made up a big piece of that pie. So the cost is constantly going up on health insurance, and it's, believe it or not, really not the insurance carriers that drive that. It is truly the cost of utilization, the bills they see from providers, the costs they absorb from pharmacies. So even though it's really easy to kind of look at United Healthcare or Blue Cross or Priority or whoever and point the finger and make them feel like the bad guy, the reality is the system in America is expensive, and legislatively, regulatorily, we haven't done anything post ACA to really impact things on the cost side. So as ACA compliant plans become a little less sustainable and a little bit less attractive, people have looked to some other options. And when I say ACA non-compliant, don't look at that necessarily as a negative. If it fits your situation, it might be a good option. Catastrophic plans are technically ACA qualified. I put them back in this section of the slide deck because they're very much outside of the traditional coverage experience. They have a very limited eligibility, although President Trump did just expand this pretty significantly. Previously, they were only available to folks under 30, and you had to be below I think 250% of the federal poverty level. Now they've expanded them, so virtually anybody with a hardship for affordability can qualify. So it's no longer about age. If you are above 400% of the poverty level, below 138, if you are newly ineligible for premium tax credits, which is likely for a great many people if they don't renew those subsidies under the Inflation Reduction Act, you can qualify for catastrophic coverage. These plans are not eligible for premium tax credits. But the pros are they have low premiums. They do include essential health benefits. Without cost sharing should have a little asterisk there. Really, it's that certain essential health benefits are covered without cost sharing. Things like maternity and stuff, obviously, you're still getting cost sharing on. They are required to include 3 primary care visits before deductible, and they are HSA eligible. The downside is the financial exposure they leave you with. They have very high deductibles, very high out-of-pocket maximums. They truly are catastrophic. These were originally designed for the young, healthy kids out there who are too old for their parents' coverage, don't really need health insurance outside of that whole I might have an accident someday kind of scenario. So they were never built to fit a wide range of the population. And I always caution people not to treat them like, a really rich health plan, because they are not. But in certain circumstances, they can be a nice fit. Oops. Whoa. Whoa. What happened here? There we go. When we talk about other non-compliant options, I generally break it down into things like private insurance plans, things that are not in the commercial market, health shares, and short-term plans. I'll take those in a little bit of a reverse order. Short-term plans can be a great solution if you are between coverages. If you're between jobs for a short term or a short time, or you leave a job and you've got 4 or 5 months before you're going to qualify for Medicare, they can be a fantastic option. But they're not renewable long term, and they don't have a full set of benefits. They tend to lean a little more towards the catastrophic side. So you have more financial exposure, but they protect you in case of a major issue. Generally speaking, you can have them for 6 months. In some cases, you can renew them for a second 6 months. After that, you're done until another calendar year has elapsed. Health shares, I only bring up, this is the only time I will do this in this whole presentation, but I only bring them up to give you a strong caution against them. You'll often hear these called health sharing ministries or health sharing arrangements. They are not insurance. They're not regulated like insurance. They are the wild, wild west situations where you band together with a group of people under a tax ID and agree to contribute a certain amount, and the health share should pay the claims out for whatever cover services they choose. But because it's not regulated as insurance, they're not really required to cover services, and they can choose. And all it takes is one person in the share getting a cancer diagnosis or something like that to really upend the financials. And so while these have gained a lot of traction over the last few years since the individual mandate of the Affordable Care Act, the requirement that you carry coverage was repealed, they're a really risky option. And, I go back in this industry far enough to think about, in the early 2000s, there were a number of third-party administrators that didn't pay claims and led to massive problems for members in bankruptcy, led to, executives going to jail and all sorts of things like that. I see health shares as being every bit as risky as some of those practices that have been outlawed and virtually disappeared at this point. Now, at the other end of the spectrum, private plans are a totally different animal. I guess I don't have the slide I thought I did. These are plans that don't meet the requirements of Affordable Care Act, but they are truly insurance. So they may be medically underwritten. You may have to answer health questions and qualify. They can have prohibitions on pre-existing conditions or waiting periods for them. they can set caps on certain benefits within them and say, you get 5, primary care visits a year, or you're only allowed to have 1 kid in a year's period, and if you have twins, we only pay for one of them. Um, I've never seen that one, but they do put caps on benefits sometimes. We used to talk about those plans as being called mini med, very often, and, that is really kind of the modern equivalent now, or what they call limited day plans. But, the pros to private plans is that because they're not ACA compliant, don't have those same requirements, they can have a much healthier risk pool, generally speaking, which drives premiums down really significantly. So, and they often have a range of coverages. So if you want a rich benefit with low deductibles and low copays, it's out there. I tend to see people buy these more when they're, in that younger, healthier phase of life, where, a bronze plan even looks expensive. You can find some very stripped down, private health plans that still give you a good level of coverage, more peace of mind than the catastrophic space. If you can jump through the hoops and live with kind of the pitfalls there that I've got listed as cons here. So obviously, not being ACA qualified, none of them qualify for premium tax credits or cost sharing reductions. But, in theory, the difference in premium means you probably don't need them. So this year, more than ever before, I have had clients ask me about these, private health plans, like crazy, quite honestly. And there are reputable companies in the market. In fact, a lot of our, the big insurers you think of play in this space too. Cigna, for instance, offers a bronze PPO option with a huge network, and the cost is probably about a third of what a similar ACA plan would be. But you have to pass the medical underwriting to qualify. So something to keep in mind. And again, this being a very personal decision, you got to think realistically about your own health, your needs, and how much risk you're willing to shoulder. If you buy a plan that doesn't cover enough, something comes up, are you going to want to pull the cash out of your savings or do whatever you have to stay solvent? And this is, we can't talk health insurance without admitting that bankruptcy due to health costs is a very real thing, and it's gotten better over the years, but entirely possible. Of course, I mentioned employer-sponsored options at the beginning, and so we'll touch on these a little bit here. I'm just gonna. All right. So if your spouse is not retired and has coverage available to him or her, it can be a good option. Generally speaking, employer-sponsored coverage is ACA compliant. There are plenty of employers out there that have self-insured plans or level funded plans and so on and so forth. Most of them technically meet ACA compliance requirements. And they tend to be very cost effective because generally employers subsidize some portion of that premium. Obviously, if you're moving from one plan to another, you may experience some disruption in your provider network, in how a drug is covered, those kind of things. So those are always things worth evaluating. And any good agent will sit down with you, happily take a list of your medications and your doctors and make sure they participate and fit into any plan that they're going to show you. Because those are the things that really matter. At the end of the day, you want to go to the pharmacy and, get your prescription covered. You want to see the doctors that you have a relationship with and that you trust. So, again, retiree benefits. If your company offers retiree benefits, I will almost always tell you take them. It's definitely worth evaluating your options, as you approach Medicare to make sure that they remain the right fit for you and they coordinate with your Medicare. But generally speaking, they are employer subsidized and they tend to be a very rich benefit. The downside is you just don't see them that often anymore. There was a time all the big companies offered some degree of retiree healthcare. Nowadays, it's pretty few and far between. And, you know, in the probably under 1,000 employed space, I don't know if they even exist. I haven't seen anybody that small operating in a very long time. Cobra, Cobra's tricky. It gets a bad rap because, really you get to pay the whole premium of your group insurance coverage. So while group benefits, and I tend to think of group benefits as always being a little bit richer, a little bit more cost effective than stuff on the individual market. And so I tend to lean towards if you have group benefits available, they're very often the right option for you. The trick is that if your employer shares the cost on them, when you move to Cobra, you get to cover the whole premium. They don't have to contribute to that anymore. And they can tack on a 2% administrative charge, so they can actually charge you a little bit more. It's not usually significant, but that tends to feel like a big chunk of money when you've been on a group plan all these years and, you know, you've seen a couple $100 go out of your check every 2 weeks. When you get strapped with the whole premium, it feels big. But Cobra can really be a good option for you, especially if you are treating something and you don't want disruption to your provider network or your drug formularies and those kind of things. It's a good way to kind of keep that continuity. It's also, if you end up in a situation where you become Cobra eligible in the middle of a plan year, if you have already gotten close to or hit your deductible, contributed a bunch towards your out-of-pocket maximum, it'd be a nice way to not just throw that money out and reset, jumping into an individual plan. So, this is something that we frequently consult with clients on to evaluate as an option. And it's probably an even split where, you know, we'll tell somebody, Cobra's the best option you got for the time being, exhaust it, run it out, you know, you've got 36 months, you've got 18 months. And then we'll look at, you know, getting you into a plan at that point. There are other situations though, where, you know, maybe the employer had a fairly weak benefit package, and they didn't contribute anything to begin with, where if you're healthy and you're not anticipating any major issues, you know, jumping on the individual market, especially with, you know, less income than you had before, can make more sense. So again, this is where I say, if you find yourself in a situation where you're evaluating it, don't go it alone. Talk to an expert. Part-time employment, again, kind of jokingly, but really Costco, Starbucks, Amazon, they all extend benefits down to folks at 17 and a half hours a week of employment. So when you hear folks joke about, you know, becoming a Walmart greeter in retirement, there's some truth to it. I don't think greeters at Walmart get benefits as far as I know, but there may be options, and you never know, if you have a passion in life that, you know, if there's a retail outlet for, or a small family business that you can work for and have some fun with. I always, I dream of working for Rockler Woodworking in Novi, just for the discount. I don't think they have benefits, but, you know, in some situations this can work for somebody. But of course, the con is, back to the workforce. So I include a little bit of information here about supplemental strategies, really to get you thinking. What I mean by supplemental strategies are non-traditional major medical plans. These days, I'm sure you've seen the commercial with the duck. Okay. Aflac is not always the right option. There are lots of insurance carriers that offer a huge variety of different benefits. Things like gap coverages that'll fill in the exposure you have within a health plan, hospital indemnity plans that, you know, kick in if you end up admitted to the hospital. Some will even kick in if you're admitted for observation, but not truly admitted. Critical illness plans. We've got a carrier that writes a plan specifically designed for cancer, heart attack, and stroke, and accident plans. A lot of these will give you options to add benefits within them too. So like you buy a hospital plan, you can add ambulance riders and sometimes specific riders for cancer and those types of things. And the reason I bring these plans up is because they have very, very low premiums. You can buy a pretty well-built hospital plan for about $100 a month. And if your risk tolerance is high and your health is good, that means you can take a cheaper major medical plan, supplement with something like this, and save an awful lot in monthly premium. This works in the Medicare space too. In fact, if anybody tells you to buy a Medicare Advantage plan, I am all for it. Like Medicare supplement's great, but if you're going the Medicare Advantage route, buy a hospital plan to go with it, because that's your biggest exposure in a Medicare Advantage plan is the hospital copay. And most of these plans will put cash in your hand. They don't coordinate with your insurer. So that's the challenge here. You have to be savvy enough to remember, I have a hospital plan and I have to submit an EOB to make a claim, but they will reimburse you for your costs, whatever's structured in the plan. So you can build them specifically to meet your hospital copays in an Advantage plan or something like that. And you can use the money however you need it. You use it to pay, for lost wages. You can use it for, pay for transportation, pay for food, whatever it amounts to, that you need. So this bundling benefits can really be a nice way to find cost savings if you're willing to deal with coordinating the benefits yourself rather than having the health insurer do it for you. So always worth a little bit of consideration. Again, it's all about reducing financial exposure, putting cash in hands and enhancing your protection for a scenario that you're, comfortable with, and building that peace of mind. Downsides, again, it's an additional bill to pay. They don't coordinate, and there are situations where some health plans find some of these incompatible. Most of the time that is when I talk about gap options. Some insurers don't like gap plans. They take the stance that can impact the actuarial value of a plan, which thereby makes it ACA incompliant. That has not been challenged in court in all these years, which kind of amazes me. And insurers tend to take polar opposite views on it. So Blue Cross is really anti wrapping for gap, whereas many of the other regional carriers are very open to it, and they kind of look the other way and say, not us. If somebody wants to underwrite that risk, be my guest. So one of those things that your agent should be aware of in making sure he's pairing benefits together that work as well together as possible. And then last but not least, this is a big one, especially as you start planning for retirement in my eyes. If you're planning to travel abroad specifically, always plan for your health, because your major medical, whether it's ACA, private insurance, individual, Medicare, really what you're going to have at best is emergency coverage if you're abroad. And in most cases, you're going to end up having to pay out of pocket and seek reimbursement. And you're not really guaranteed much in the quality of care you get. So if you're going to travel abroad, there are great travel insurance companies out there. There's a company called Geo Blue. Actually, they just rebranded last week, and I can't remember their name now. But they are part of the Blue Cross Blue Shield Association. They are a nonprofit. They offer fantastic plans, and they're not the only one out there. They're just the one that I tend to lean towards. But they guarantee you access to doctors that practice Western medicine. They pay providers directly, so you never have to. They have massive networks internationally. They'll provide translation services. They'll evacuate you if they can't get you the care you need where you're at. They will provide for repatriation if the unthinkable happens. They'll get your body home. The good ones don't exclude destinations for terrorism or war zone or anything else. And a lot of them have some extra benefits. You get kind of 24/7 live concierge service to help you navigate where you are from a health perspective. Many of them will help you deal with chronic conditions if you're traveling abroad over a long period of time and you need to manage those. They also very often have really good travel apps with everything from weather alerts and stuff on down. And the cost is next to nothing. Like if you're just doing a single trip package, and they do offer like global expat coverage if you're going to be abroad for a long time, or if you're planning on living on a cruise ship in retirement, it's an option. just saying. But they, a single trip package, most of the time you're maybe talking 35, 40 bucks. It's worth it for the peace of mind. So something to consider.